Welcome to the MUFG Global Markets FX Week Ahead podcast with Lee Hardman, Senior Currency Analyst at MUFG. It's Friday, 6th of February 2026, and joining Lee to pose some questions on the financial market themes for the week ahead is Abdul-Ahad Lockhart, Currency Analyst at MUFG. This material is only intended for professional investors in jurisdictions in which its use is permitted under applicable laws, rules, and regulations. It has been produced for information purposes only and should not be construed as investment research or advice. MUFG EMEA disclaimers and disclosures can be located on our website.
Hi, Lee.
Hi, Abdul-Ahad.
The lower house election is due to take place in Japan this weekend. What impact do you think this will have on the yen?
Yeah, as we've seen this week, the yen has been weakening again. We've seen dollar yen rising back above the 157 level as it moves back closer towards the highs from a couple of weeks ago when dollar yen moved closer to the 160 level. Obviously, on that occasion, dollar yen dropped sharply down to the mid to low 150s after we saw the threat of intervention from Japan was stepped up significantly, and we heard reports as well of the New York Fed carrying out rate checks, which added to speculation that the US could even join Japan in intervening to support the yen and driving down dollar yen. But as we said at the time, we were not convinced that this kind of move higher for the yen would be sustained, and that's kind of what's played out certainly over the last couple of weeks, with the yen back on a weaker footing heading into this weekend's lower house election in Japan. As we've seen over the past week, the yen's weakening momentum has been reinforced by the release of a couple of opinion polls ahead of the election, highlighting that the ruling coalition government between the LDP and Japan Innovation Party appears to be well on course to strengthen their majority in the lower house. Prior to the recent dissolution of the lower house, the ruling government only had a very slim majority of 233 seats in the 465-seat lower house. But it looks like they could certainly strengthen that position potentially significantly at the weekend. And if that does play out as the opinion polls are pointing to, that would then give Prime Minister Takaichi a stronger mandate to continue with her reflationist policy agenda. And it's those fears over the risk that we should continue to see a looser fiscal policy, the potential there for higher inflation in Japan, with the BOJ seen as being behind the curve in terms of raising interest rates in Japan, that has been encouraging further yen selling. So if we do see a strong result for the government at the weekend in the election, then I think we could see another bout of yen selling at the start of next week. Obviously, then that would push up dollar yen towards the high 150s again pretty quickly, and then that would obviously put the government in Japan in a difficult position. The market would be anticipating that they would again step up verbal intervention. But as we've seen, eventually they'll have to back up this verbal intervention with direct intervention in the market as well to support the yen. So that should help to try and limit at least the downside for the yen initially after the election results at the weekend. The alternative, obviously, is if there's a big surprise and the government fails to strengthen their position in Parliament. Obviously, that's not suggested as a likely outcome from the latest polls, but if that surprise outcome happened, that would obviously be very damaging for Prime Minister Takaichi, and we could then see quite an abrupt reversal of these Takaichi trades, such as short yen positions that have been built up over the last couple of months.
Thanks, Lee. And bringing it back to closer to home, the Bank of England sprung another policy surprise this week. Why has the pound weakened sharply in recent days?
Yeah, like you say, the pound had been kind of outperforming, particularly against the euro at the start of this year. We saw euro sterling falling down towards the 86 level at the start of this week, but since then we've bounced back above the 87 level, which has mainly been driven by two factors. One, I would say, was the surprisingly dovish policy update from the Bank of England this week. While we did expect the Bank of England to still leave the door open for further gradual rate cuts this year, We were surprised by how close the decision was this week to leave rates on hold. The 5-4 vote was a lot closer than we had anticipated. And even among the 5 MPC members who decided to leave rates on hold this week, a couple of those members, Governor Bailey and Catherine Mann, had indicated that they are thinking more seriously about potentially cutting rates at upcoming policy meetings. So that has encouraged the rate market here in the UK to bring forward the timing of the next rate cut until the next meeting in March. So that's put downward pressure on UK yields and the pound. And then the second factor as well, which is more of an unknown and an uncertainty, is renewed concerns over political stability here in the UK. The ongoing fallout from the release of the Epstein files is certainly casting further doubt on Prime Minister Keir Starmer's ongoing position as Prime Minister here in the UK. Obviously, his previous decision to appoint Peter Mandelson to be the ambassador to the United States, that decision is obviously being questioned, and it is encouraging people within the Labour Party who are considering launching a leadership challenge to think more seriously about that. And that risk of a leadership challenge remains kind of very much on the table ahead of the local elections in May. So that's, to us, still remains a significant potential downside risk for the pound if we were to see that leadership challenge emerge in the coming weeks or months. Now, Abdul-Ahad, as well, I know you have been doing some text analysis, looking at the recent updated policy communication from the Bank of England this week. It'd be interesting to hear your thoughts on what the kind of key takeaways were.
Yeah, of course. So the Bank of England kept rates on hold at 3.75% this week in a surprisingly tight vote, effectively laying the groundwork for a rate cut in the March meeting. So our analysis shows policymakers are increasingly confident in the ongoing disinflation process, with the MPC narrative shifting decisively from inflation dynamics towards degradation in activity and labour market conditions. So references to the real economy exceeded the upper quartile range of our 3-year series. This reflects a clear signalling strategy. Across member statements, there is a consistent pattern of repeated mentions of weak activity, evidence of widening economic slack, and explicit concerns about their downside risks to growth. So inflation uncertainty is now framed as conditional on demand conditions, with several members linking the latest disinflation trend to a slowing economy. So references to the labour market also surpassed the upper quartile threshold, with multiple MPC members now viewing the labour market as a key channel through which disinflation will continue to run. This reflected in language such as weakening of the labour market, material loosening, and unemployment rising to more than expected. The committee appears increasingly confident that cooling labour market conditions will anchor the current disinflation trend. So within our MPC dot plot framework, Governor Bailey remains the pivotal swing vote. However, we highlight a meaningful dovish shift from Catherine Mann, whose statement that current developments have moved the appropriate time for the cut in bank rate closer, placing her firmly within the dovish camp. So for effects this week, this communication from the Bank of England marks a decisive pivot towards easing. We expect this to weigh on the pound, particularly against the dollar and the euro, as earlier Bank of England easing expectations push UK short yields lower and reducing its carry advantage. A narrower UK-US and UK-EU rate spread weakens the pound.
Great, that's good to hear, Abdul-Ahad. It certainly supports our current outstanding trade recommendation of long Aussie against the pound, where we've been highlighting the potential there for interest rate differentials to move in favour of a stronger Australian dollar against the pound. As we saw as well earlier this week, the RBA started to raise interest rates as the Bank of England is moving closer to cutting rates again. So that certainly should reinforce the upward momentum for that trade recommendation. And then finally, just to say thanks everyone for listening and have a good week ahead.
Thank you for listening to this MUFG Global Markets podcast. Rate, review, and subscribe. Contact your MUFG sales rep for more information. Come back next week for more insights from the Global Markets Research team.